So, I mean, you kind of set out already kind of the three pillars that the book also describes with regards to value creation and the overall kind of digitization or the transformation agenda around it. And I think there are three kind of core pillars. One is operational efficiencies, which very much is driven around profitability and shaped by kind of the innovation we've seen in software and infrastructure components. The second one is kind of decision making, which is driven and augmented by artificial intelligence and big data. And the third one, very much around digital financial information, which comes through blockchain technologies and crypto assets and kind of the broader agenda around decentralized finance or DeFi. And I think to come back to your question, I think the core or the imminent kind of impact we've seen has been very much around operational elements and operational efficiency, which kind of addresses the imminent profitability challenges that the banking sector faced after the global financial crisis. And there are then topics more further down the line, such as infrastructure and DeFi in particular, which will fundamentally change the system as we're knowing it today. And banks responding accordingly, if they have been invested through principal investments in a lot of the startups, while also acquiring them. And we've seen several large kind of big technology vendors coming together to provide more comprehensive solutions while we're working on these different components of the agenda.
The global banking sector has been notoriously Joerg, I just wanted to ask around the pace of adoption of new technology, because historically speaking, these global investment banking giants were very slow at adapting and bringing on new technology. And in many cases, they're behemoths with many different systems integrated over the years. Is that changing now?
I think they've been very slow in adoption. And I think that's one of the core challenges, right? If you look at it again, where cost income ratios are and how it's been reported, or return on equity and the respective expectations, they have been slow in addressing those issues, but it's also easier said than done, right? Because these are very complex technology platforms that have a global scale. And the incoming kind of regulatory agenda and the operational complexity around it has made things much more challenging than it probably has been in the past, as a lot of those systems were also built back in the 70s and 80s, and not many institutions have put in place kind of multi-year transformation programs. So it remains a core challenge, but it's been accelerating also by the innovation that has come through, and also that allows a much more better cooperation, collaboration between the banks with regards to open architecture or other components that allows to facilitate and work together as we're moving into a new kind of structural environment. So they have been slow, that's true. It's in particular true if you compare it to other industries, such as the consumer good industry, which has known those kind of models for a long time. But at the same time, it's also accelerating, and we're moving more quickly as kind of the components become more flexible to pull things together and make sure that they can focus on kind of their core components, which is then reflected in the technology platform.